You've probably heard the term derivatives thrown around, right? On one hand, people call them essential risk management tools. On the other, you hear them called financial weapons of mass destruction. So what's the real story? What even are these things? Well, today we're going to pull back the curtain on one of the most powerful and, controversial inventions in modern finance.
So here's how we're going to break this down. First, we'll cover the basics, what a derivative even is, then who's using them and why. After that, we'll take a quick tour of the most common types. We'll weigh the pros and cons, and finally, we'll get into why all of this has such a massive impact on the entire global economy. Let's dive in.
Okay, so first things first. Before we can really get into all the power and the danger, we have to get our heads around the core idea, what a derivative actually is.
You know, when you really boil it down, derivatives serve two main purposes that seem like total opposites. Are they a financial shield to protect you from risk, or are they more like a way to make high-stakes bets on the future? And the crazy thing is, the answer is both. Yeah, both.
Okay, so here's the absolute key to understanding this. A derivative is just a contract, but its value, it doesn't come from the piece of paper itself. Its value is derived from something else. That's where it gets the name. And that something else can be pretty much anything you can imagine. The price of a barrel of oil, the value of Apple stock, the exchange rate between the dollar and the yen, or, and I'm not kidding here, even the amount of rainfall in Ohio.
So all of these contracts, they share a few key traits. They're agreements between two parties, and their value is always tied to that other underlying asset. But here's a really crucial part, where they trade. Some are on public, regulated exchanges, but many of them are over-the-counter, or OTC, which just means they're private, custom deals made directly between two parties. You're going to want to remember that little detail, because it becomes a huge deal later on.
All right, so we know what they are. But why does a market for these kinds of abstract contracts even exist in the first place? Well, it turns out it serves two groups of people with completely opposite goals.
On one side, you have the hedgers. These are businesses or investors who are looking to get rid of risk. Think about a farmer who wants to lock in a price for their crops so they're protected if prices suddenly crash. Then, on the other side, you have the speculators. They're the ones who willingly take on that risk, betting on which way a price is going to move, hoping for a big payoff.
And this sums it up perfectly. The whole market is basically a giant risk transfer machine. The farmer, who doesn't want the price risk, can use a derivative to pass it over to a speculator who is happy to take that bet. It's a perfect, if risky, match.
Now, this transfer of risk isn't just some vague concept. It happens through very specific, legally binding contracts. So let's take a quick tour of the four most common types you're likely to run into.
First up, we have futures contracts. These are standardized deals to buy or sell something at a future date for a price you both agree on today. Let's make that real with a classic example.
So, imagine an airline. They know they're going to need a ton of jet fuel in 3 months, and they're worried the prices are going to soar. So they buy a futures contract today, locking in a set price. Now, this is an obligation. The airline has to buy, and the seller has to sell at that price, no matter what happens to the market. Just like that, the airline has successfully hedged its risk.
Now, I really want you to focus on that word obligation. It's a commitment. And that is the single biggest difference between futures and our next type of derivative, which is all about creating an opportunity, not an obligation.
And that brings us to options. An options contract gives the buyer the right, but, and this is the key part, not the obligation to buy or sell an asset at a set price before a certain date. You just pay a small fee, called a premium, for that right.
Let's look at two simple ways these are used. A protective put is basically like buying insurance. You own a stock, you're worried it might fall, so you buy a put option that gives you the right to sell it at today's price. It's your safety net. Then you have the speculative call. This is when you think a stock is about to rocket upwards. You can buy a call option, giving you the right to buy it at today's lower price later on. This lets you control thousands of dollars worth of stock and capture all that potential upside for just a few bucks. That's financial leverage in action.
Finally, let's quickly touch on two types that are the real workhorses in the corporate world: forwards and swaps.
Forwards are simple. Think of them as futures contracts, but they're completely customizable and they're traded privately, over the counter. Swaps are more interesting. They let two parties literally swap financial obligations. Imagine you have a loan with a floating interest rate that could spike at any moment, and I have a loan with a safe, fixed rate. If you want my stability and I'm willing to bet rates won't rise, we can use a swap. You agree to pay my fixed payment, and I agree to pay your risky floating one. We've just swapped our cash flows to manage our own risks.
So you can see just how powerful these tools are for managing risk. But that power is absolutely a double-edged sword, which leads us to the fundamental trade-off, the pros and cons.
At the heart of both the good and the bad is one single word: leverage. Because you only have to put up a small amount of money to control a huge financial position, your potential returns can be magnified like crazy. But, and this is a huge but, so can your losses. Leverage cuts both ways, and it cuts very, very sharply. The pros are pretty clear. You can lock in prices, hedge against risk, but the cons are serious. These contracts can be incredibly complex. But the real danger, especially with those private OTC deals, is something called counterparty risk. I mean, just ask yourself, what happens if the other side of your billion-dollar bet goes bankrupt and simply can't pay you? And that question, what happens when someone can't pay, is exactly why this all matters so much, far beyond the walls of Wall Street. Because the sheer scale of this market is almost beyond belief. In mid-2023, the total estimated value of all derivatives contracts out there in the world was around $715 trillion. That's not a typo. Trillion with a T. It's a number so vast it's hard for our brains to even comprehend. And it shows just how deeply embedded these things are in the global financial system.
And that's really the final piece of the puzzle. While derivatives are essential tools for managing an individual's risk, their complexity and interconnectedness can create massive systemic risk that's risk to the entire system. When one party defaults on one of those over-the-counter contracts, it can create a domino effect. And that's exactly what we saw happen with certain types of swaps during the 2008 financial crisis.
So, we end right back where we started. Are derivatives a vital tool for creating economic stability by helping us manage risk? Or are they a trigger for crisis, concentrating risk in unseen corners of the financial system? The truth is, they're both. And understanding that duality, well, that's the key to understanding modern finance.